Hey everyone, welcome back to Finance 101. In this video, we'll talk about types of mutual funds. Now basically there are four main types of mutual funds. The first one being equity mutual fund, the second one being debt mutual fund, that is DEBT mutual fund, the third one being balanced/hybrid mutual fund, and the fourth one being money market mutual funds. Now we'll talk about each and every single one of them in this video. So first we'll talk about equity mutual funds. The first one is equity mutual funds. Now it is a type of mutual funds that invest basically mainly in stocks. Now this type of mutual funds are preferable for investors who are having high amount of patience to give their money to the mutual fund managers. Why? Because they carry high risk associated with it. Though high risk is accompanied by high return as well, but if you are having patience, then it is preferable that you invest in equity mutual funds. How it works? It is basically a long-term investment strategy that you give your money to the mutual fund manager and he or she will invest your money into stocks and into companies that will think perform better in the future. And if the stocks perform well, you'll get good return, and if the stock performs badly, then you'll incur losses. So it is preferable for investors who want high return but at the same time are having high amount of patience. The second one is debt mutual fund, that is DEBT mutual funds. It is basically a low risk and low return strategy. This investment can be for long term as well as short term. This mutual fund invests basically mainly in government bonds, corporate bonds, deposits, etc. How it works? Basically, whenever you invest money in bonds, you give your money to the government for a fixed amount of time. I'm talking about government bonds. You give your money to the government for a fixed amount of time, and at the time of your due date, that is when you get your money back, when you're supposed to get your money back, you receive the whole investment back, as well as between the due date and the borrowing date and the lending date, you'll get interest at regular intervals of time. So government bonds are a good way of earning minimal returns but assured returns, because as the government is a regulatory authority, it is very less likely that there will be case of defaulting and you won't get your money back. So debt mutual fund is when you want to minimize your risk and have sufficient returns so that you can sustain. The third one is balanced/hybrid mutual funds. Now, as the name suggests, balanced mutual funds. How they work? They are basically a combination of debt and equity mutual funds. They invest part of your money in debt and part of your money in equity, such that the overall risk diversification is minimized. It is a very good investment scheme, because though it generates moderate to low returns, but your risk diversification is very good. So if you want to have low risk and want to generate moderate to low returns, then you can definitely invest in balanced/hybrid mutual funds. The fourth one is money market mutual funds. Now, money market mutual funds, as the name suggests, invest basically your money in money market instruments. Now, as per SEBI norms, these schemes must invest your money in money market instruments for a maturity of up to 1 year. Now, money market mutual funds, the money market instruments are basically commercial paper, treasury bills, deposits, and such things. Now, why is it so special? Now, it is special because it is basically for investors who are having very little tolerance for risk. Because as the maturity is up to 1 year, it is very likely to be sensitive about interest rate changes. Because in 1 year, interest rates won't change very much. So, money market mutual funds are basically very preferable for investments which are having less preference and less tolerance for risk. And also, there is very less likely that money market instruments will have higher risk attached with them, because they are generally safer and secure than equity mutual funds, because they invest basically mainly in stocks. So, this video was about types of mutual funds. Now, if you like this video, please make sure to hit the like button, subscribe to this channel, share this video with your friends, make them financially literate as well, and I catch you guys in the next video. Till then, take care and bye.